now to tech names. Let's get right to the floor show. Joining me now, Bernstein Private Wealth Senior Investment Strategist, Roosevelt Bowman. Roosevelt, as if to underscore that question, S&P Global came out last night and said that the index, that obviously the blue chip index, Google will replace Verizon starting on Monday. I think that took some people by surprise, and certainly it's not good for Verizon stock, which is the second worst on the Dow heat map right now, but leads to that question, is the Dow now overexposed to tech?
I think that's the challenge for passive investors broadly, whether you're talking about the Dow or the S&P 500. That's been a persistent problem for investors. That's where we would say, hey, there's other places to go to take advantage still of the AI trade and other themes entirely. You think about aerospace and defense, you think about industrial innovation, manufacturing innovation. Those are great places where you can avoid some of those kind of nosebleed valuations.
I suppose you could look back in, much earlier 1900s when the Dow Jones Industrials were all industrial, heavy equipment companies. But today, you've got IBM, Amazon, Apple, Microsoft, NVIDIA, all of those names in the Dow right now, and now you're going to add Alphabet to it. I mean, granted, Alphabet's market cap is so much more gigantic. It's more than $1 trillion, while Verizon's is about $190 billion. But Verizon has a great yield, and it's a telecom.
Right. And I think to your point, Liz, that's where you really have to look outside of those names, because a lot of the names you mentioned, they're involved in similar projects in terms of investing in data centers and part of the AI infrastructure build out. So where else can you go, right? You can look at some of the names in terms of consumer credit names and things of that sort that are taking advantage of the AI tools becoming cheaper and cheaper, using those tools to expedite their credit card transactions or to help out with their cybersecurity needs as well. So there's plenty of other places to kind of go outside of that.
So you're saying the beyond semis trade, and clearly that's been reflective in the Russell 2000 and the nice year-to-date gains that index has made. So there's that, but also specific sectors, would you say, that are unrelated to that core AI trade? For
sure. I mean, I think a couple that we touched on briefly, you think about healthcare innovation. There's so much that can be done there. A lot of the focus has just been on drug development. And make no mistake, that's been really impressive. You're able to take these massive models and all of a sudden run calculations and computation at a much faster rate than you could before. But there's so much that can be done to improve kind of patient caregiver information sharing and also improve in terms of surgery, robotics. You think about the manufacturing innovation as well. There's two main costs that you have when you think about running a manufacturing facility. You have your energy costs, you have labor. AI can help with both. You're talking about using AI and machine learning models to improve the energy consumption and distribution in your facility. Also, if you can hire fewer people and replace some of those workers with automation, you can keep your costs down as well. So those are kind of beneficiaries of some of these tools that are not so concentrated in semiconductors and some of the chip names that, again, the valuations are extended.
Does it surprise you that earlier the S&P saw a high jump of about 62 points, and now it has completely reversed? We do have it down about 26 points. Same with the NASDAQ, as I mentioned, high this session, a gain of 253, low down 204, and right now we're down about 222. So we've already, in this couple of minutes, blown through that floor.
Yeah, I would say not really. I'm not surprised. I think this is something that we have to get used to going forward, more of this intraday volatility in the tech sector. And I think the main reason for that is you think about the retail involvement that in terms of equity volume trading, it's about twice what it was 15 years ago. So you have a lot more people involved in this trade. And the technical subject, AI, of which many people are not that well versed in. And so you have more activity with a complex subject kind of leading the market. You're going to have more sentiment-driven moves and more of that intraday volatility.
And let's not forget, tomorrow we get two huge pieces of economic data. We get the PCE, this is the Fed's favorite inflation data, personal consumption expenditure, and that's expected to jump to about 4.1% for the month of May. That's not in the right direction.
No.
It's supposed to be 2% according to the Fed. It's not. And then you've got GDP, the final print for first quarter, rear view mirror looking.
Absolutely.
But at this level, we are expecting to see GDP 1.6%. Scott Bessent, the Treasury Secretary, yesterday at the Economic Club of New York said, oh, it's going to be 3% by the end of the year. Is that wishful thinking?
I think that it's ambitious, I'll put it that way, from a growth perspective. And a lot of investors have been focused on this short-term inflation picture. I think we would argue that the PC is somewhat backward-looking as well because it's supply-driven inflation. You constrain the supply of a commodity, that's pushing up the prices of goods and services across the economy. That's not what we saw in 2022, which was demand-driven inflation, wage pressure, causing a bidding up of goods and services across the economy. So we do think this is very different. When you look at the Fed historically, they've responded a lot more to demand-driven inflation rather than supply-side inflation. And so even the PC number is somewhat backward-looking. And really what we're more focused on is what's the impact on consumption and growth ahead. Did some work on this. When you think about this type of oil price spike that's really breaking out to new highs, that typically has a much stronger negative impact on consumption and consumer behavior going forward. You end up with a drag of about 40 basis points on GDP 3 to 4 quarters ahead.
Well, I would say, obviously, crude oil has come way off the highs of the past war couple of months. So, that is certainly a big plus. It's below $70 a barrel right now for West Texas Intermediate. That's great for the consumer. We'll continue to watch it. Maybe that's why consumer discretionary is the best performing sector right now on the S&P. Roosevelt, great to have you. Thanks.
Thank you again, Liz.